What about using debit spread to speculate in stock markets? Opposite of a credit spread, this strategy involves buying an option and selling another option of the same type but further out of the money. It requires an upfront cost debit but can result in larger profits. What is the primary objective of the debit spread strategy in stock options trading? The primary objective of the debit spread strategy in stock options trading is achieving capital appreciation with controlled risk. This strategy involves simultaneously buying and selling options of the same type, either calls or puts with different strike prices, resulting in a net debit, which is the cost to the trader's account. The goal is to benefit from directional moves in the underlying asset while limiting the maximum risk. The primary goal of a debit spread strategy is to achieve capital appreciation while controlling risk. This strategy involves buying an option and simultaneously selling another option of the same type, such as a call or put, but with a further out-of-the-money strike price. The trader pays an upfront cost, typically a debit, for the spread, but stands to gain larger profits if the market moves favorably. How does the debit spread strategy perform under different market conditions? The debit spread strategy is effective in directional markets, meaning it performs well when the underlying asset moves in the predicted direction, which is either upward for call spreads or downward for put spreads. Its effectiveness is reduced in flat or highly volatile markets where the direction is unclear. Debit spreads are most effective in markets with a clear directional trend, either bullish or bearish, depending on whether a call or put spread is used. A call debit spread is suitable in bullish markets, while a put debit spread is preferable in bearish markets. These spreads can benefit from market movements in the expected direction while limiting losses in unfavorable scenarios. What risk is associated with the debit spread strategy? The risk associated with the debit spread strategy is limited to the initial net debit paid to establish the spread. This limited maximum loss provides a controlled risk environment. The strategy does not expose the trader to unlimited losses, unlike some other options strategies. The risk in a debit spread is limited to the initial cost of setting up the spread, which is the net premium paid. This amount represents the maximum loss if the market moves against the position. The controlled risk nature of the strategy makes it attractive for traders who want to limit their downside while having the potential for higher returns compared to outright option purchases. What potential rewards can be expected from a debit spread? The potential rewards from a debit spread can be higher gains compared to the initial investment. The maximum profit is the difference between the strike prices of the options minus the net debit paid. This strategy can offer significant returns relative to the risk taken if the market moves favorably. The reward potential with a debit spread is typically higher compared to the initial investment. The maximum profit is the difference between the strike prices of the two options minus the net premium paid. The best case scenario occurs when the market moves favorably, allowing the trader to realize the full potential of the spread. What are the key implementation steps for a debit spread strategy in stock options trading? Implementing a debit spread strategy effectively involves selecting appropriate strike prices and expiration dates for the options, determining the direction in which you expect the underlying asset to move, and calculating the maximum profit and loss potential. It's important to monitor the trade closely and manage it according to market movements and the trader's risk tolerance. A good understanding of the underlying asset's price behavior and the impact of time decay on options is also crucial for successful execution. Implementing a debit spread strategy effectively involves analyzing the market to determine its direction and choosing between a call or put spread, selecting appropriate strike prices for both the bought and sold options, ensuring the bought option is closer to the current market price, paying attention to the expiration dates, ideally choosing options that align with the expected time frame of the market move, calculating the net premium paid to establish the spread and understanding the maximum risk and potential reward, monitoring the market closely and being ready to adjust or exit the position if market conditions change. A debit spread strategy in options trading requires a clear understanding of market direction and careful selection of strike prices. It offers a balance between risk management and the potential for significant returns, making it a favorable choice for traders with a specific market outlook and a desire to limit their downside exposure. As we conclude our comprehensive exploration of various trading strategies in both stock options and futures markets, it's important to take a moment to reflect on the key insights and takeaways. Our journey has taken us through a variety of strategies, ranging from the income-generating covered call to the protective married put in stock options trading. In the realm of futures trading, we have looked into strategies like trend following and pivot points. Each of these strategies serves specific objectives and operates optimally under different market conditions, each carrying its own unique risk profiles and reward potentials. Reflecting on the objectives and market conditions of these strategies is crucial. Remember, the primary goal of any trading strategy can be diverse, including income generation, capital appreciation, hedging against market movements, or outright speculation. The effectiveness of a strategy is deeply contingent on the prevailing market conditions. Some strategies are designed to thrive in volatile environments, while others are better suited for stable or directional markets. Understanding the risk and reward of each strategy is a fundamental aspect of trading. Every strategy comes with its potential risks, which include the maximum possible loss and the risk associated with movements in the underlying asset's price. It's essential to balance these risks with the potential rewards, which can range from the best-case scenarios to average expected returns. Personalizing your approach to trading is arguably the most important takeaway. Your investment choices should be based not just on the strategies themselves, but also on your individual goals, time horizons, and risk tolerance. A strategy that works well for one investor might not be suitable for another, depending on their financial situation, market outlook, and personal comfort with risk. As you consider implementing these strategies, it's vital to think about the specific steps involved. This includes choosing the right strike prices and expiration dates for options or determining entry and exit points for futures. Also, consider any special skills required, such as technical analysis, for effective trading decisions. As we move forward from discussing strategies to making personal investment choices, it's important to reflect on your unique financial landscape. Consider your long-term objectives, the level of risk you're willing to accept, and the time you can dedicate to managing your investments. Successful trading is not just about selecting the right strategy. It's about aligning that strategy with your personal goals, your understanding of the markets, and your risk appetite. In summary, the art of trading and investing is as much about knowing yourself as it is about knowing the markets. As you ponder these strategies and their implications, consider how they align with your personal investment philosophy and how they can be tailored to fit your unique journey in the world of trading and investing. Navigating the complex world of trading and investing requires understanding the nuances of various strategies in both stock options and futures markets. As we conclude our extensive journey, we reflect on the diverse landscape of these trading strategies. We've explored a range of strategies, each with its unique characteristics and objectives suited for different market contexts. From the income-generating potential of covered calls to the risk management of protective puts in stock options, and from the market momentum strategies like trend following to pivot points in futures trading, each approach offers distinct pathways towards financial goals. Our exploration has emphasized that the success of any trading strategy is closely tied to specific market conditions and the trader's objectives. Whether it's income generation, capital appreciation, hedging against market movements, or outright speculation, aligning the chosen strategy with both market dynamics and personal investment goals is essential. Understanding the balance of risk and reward is central to this alignment, necessitating a careful evaluation of potential risks and expected returns associated with each strategy. Emphasizing the personalized nature of investment decisions, it's clear that trading and investing are deeply individualized activities. They require thoughtful consideration of one's own risk tolerance, investment horizons, and financial objectives. The right strategy for one investor may not be suitable for another due to different financial situations, market outlooks, and individual comfort with risk. When contemplating the implementation of these strategies, it's important to consider all practical aspects carefully. This includes not only selecting the right strike prices and expiration dates, but also a deep understanding of the nuances specific to each market. Special skills such as technical analysis play a crucial role in the successful execution of these strategies. As we look ahead, armed with a comprehensive understanding of various strategies and a clear grasp of personal investment philosophy, traders and investors are better equipped to navigate the complexities of the markets. The synthesis of strategic knowledge with personal insights forms a solid foundation for making informed and confident investment decisions. Successful trading and investing are as much about personal introspection and alignment with individual goals as they are about understanding the markets. Moving forward, it's important to carry forward the insights gained from this comprehensive exploration and allow them to guide you in making decisions that resonate with your unique financial narrative and goals. In the dynamic world of trading, a combination of knowledge, adaptability, and self-awareness are invaluable assets. Even though our discussion focused on speculating with futures versus stock options, did you know that there are also options on futures? In our exploration of stock options strategies, including covered call, protective put, and others, it's important to note that these approaches can also be relevant in the context of futures options trading. In future discussions, we plan to delve deeper into how these strategies can be effectively adapted and applied in the futures market. While the foundational principles of these strategies remain consistent, their application in futures options will require an understanding of the nuances specific to futures trading. This includes considerations like increased leverage, distinct margin requirements, and the characteristics of underlying assets in the futures market. We'll explore how the risk profiles and implementation steps of these strategies might differ when applied to futures options, ensuring a comprehensive understanding of their potential in various market conditions. This exploration will provide a more holistic view of the strategic options available to traders across different financial instruments and markets,